This submission lays out a really detailed case for Tonix Pharmaceuticals, TNXP.
Right.
The core argument is that the stock has finally hit its valuation floor, and that's driven by, well, a balance sheet where the cash is actually greater than the market cap, plus some big catalysts coming up.
It's a powerful thesis to start with. I mean, that negative enterprise value signal is always compelling.
For sure.
So I think the goal for this critique is to take that argument, the idea that the bottom is definitively in, and just make it completely undeniable. Structurally, financially, narratively, for anyone reading it.
Okay, so let's jump right in with its biggest strength, the cash position. The piece makes a very strong point that, theoretically, there's a floor here. It notes that the cash, which is about $190 million, is more than the market cap of about $180.
Yeah, you're effectively getting a $10 million rebate to buy the whole company.
Exactly.
It's a fantastic headline number. It suggests immediate value. So I think the material effectively uses the negative enterprise value as a core signal, but it could strengthen the argument by more deeply analyzing the specific market factors that have, allowed this disparity to exist for so long.
That's a crucial point. We're looking at this cash floor like it's a logical safety net. But if the market was perfectly rational, the stock wouldn't be down here to begin with.
Right.
The weakness here is that the analysis treats this cash as an immovable object. But it doesn't really dig into why the market has been so skeptical of that cushion.
It really comes down to the shadow of dilution, doesn't it? When a biotech company constantly uses share offerings to fund itself, investors get this kind of historical skepticism.
A kind of dilution PTSD.
Exactly. Dilution PTSD. The market is looking at that cash runway out to Q1 2027. And even with all that cash, they're betting the cash burn will force another dilutive offering before that Tomia revenue can really kick in.
So the floor exists, but the fear is the company will just print more shares and push the floor down.
Yeah.
Just stating the cash isn't enough. We have to proactively neutralize that fear.
Precisely. The suggestion for improvement is to integrate a deeper, more quantitative look at the cash burn and how this new commercial revenue really mitigates that historical risk.
Okay.
You have to show specifically how this new commercial reality changes the whole velocity of the balance sheet.
So let's make that concrete. How do we model that? Just showing the old burn rate doesn't really prove anything new.
You need to use projections. Detail a comparison between the historical average net operating loss, say the cash burn over the last 4 quarters, and then put that right up against the expected revenue from the Tomia launch.
So you create this collision course the reader can actually analyze.
Yes, it shifts the whole narrative. You go from we have cash now to we have a revenue stream that will stop us from needing cash later.
Right, so you could offer a scenario where that Q1 2027 runway gets extended.
Or shortened. Base it on early Tomia sales figures. For instance, calculate the average historical burn. Let's say it's $40 million a quarter. And then model how, say, $15 million in quarterly Tomia revenue changes that timeline.
Ah, I see.
Does that new revenue push the potential dilution date from Q1 2027 out to maybe Q4 2028? You have to show the reader the actual mechanics of how this cash position can be defended, not just by its size, but by the income statement's new power.
That completely transforms the argument. You're not just citing a cash balance anymore, you're offering an economic shield against the main bear case.
Which is execution risk on the balance sheet.
Right.
That's the goal. Address the force of historical risk. Don't just point to a single tree of current assets.
Okay, let's move to the other major risk factor, which is the catalysts themselves. The Tomia launch and the green light for the Phase 2 Horizon study. They're powerful, but success is not a guarantee.
Not at all. There are future promises. And in biotech, promises, they run into operational friction all the time. To maximize the credibility of the bottom is in verdict, the analysis needs a much more robust section dedicated to detailing the specific execution risks in these new catalysts.
I agree. The current risk section feels a little thin. It talks about technical price levels like the 1350 break and the downtrend, but those are just symptoms.
They're symptoms, not the cause.
Right. A high-quality argument has to tackle the specific operational risks tied to these two big catalysts. I mean, if the Tomia launch stalls, that whole fundamental floor calculation we just talked about goes right out the window.
The market sees execution risk, where this analysis right now sees guaranteed upside. So the suggestion is to structure a dedicated section, call it counter-arguments or maybe execution monitoring, that really addresses the potential failure points. A strong bullish thesis is one that acknowledges the toughest bear arguments and then explains how to monitor them or why they're mitigated. It proves the writer's done their homework beyond just reading the press release.
Okay, so we're looking past the announcement and focusing on the first, say, 3 to 6 months post-launch. What are the key operational hazards for Tanya in that fibromyalgia space?
Well, for Tanya, the big risk isn't FDA approval. They've got that. It's payer acceptance. You need to give concrete examples of those challenges, like what are the anticipated payer hurdles?
Will major insurance carriers even cover it right away?
Exactly. What are the potential coverage delays that could slow down adoption? And critically, what's the competitive threat from existing treatments, generic or branded? Investors need to know you've assessed the real market battleground.
That's practical risk. It gives the reader a checklist. So how do we apply that same thinking to the clinical catalyst, the new study for major depressive disorder?
MDD phase 2 trials are notoriously difficult. The weakness was just celebrating the FDA green light. That's just the starting gun.
Right.
For this new MDD study, you need to analyze the specific risks in CNS trials. For example, highlight the need to monitor patient enrollment rates. Slow enrollment means delayed results and more cash burn. But the big one is the placebo effect.
The placebo effect in depression trials is a massive systemic hurdle.
Huge.
If the analysis doesn't address the historical difficulty of separating the drug's effect from the trial design, it leaves a huge flank open for the bears.
Absolutely. Show that you're monitoring for efficacy margins against the typical placebo response in MDD trials, instead of just waiting for a pass-fail headline. By showing that high-level understanding of phase 2 risk, you boost the significance of the entire thesis.
That's excellent. Now let's pivot to how all these pieces fit together. You mentioned the writer has gathered some great data on institutional buy-in, but it doesn't quite land with full impact yet.
Yeah, I was really excited by these data points. The analysis notes this massive institutional accumulation in Q3 2025. You have Vanguard up 238%, BlackRock up 62%, Millennium Management up a staggering 494%.
And this is just listed alongside the technical support that formed around the $13.80 to $14 zone.
Right, it reads like two separate things, one section on institutional flow, another on technical analysis. This separate presentation of this massive accumulation and the technical support, it needs to be tightly integrated to show a cohesive narrative about why the reversal is happening right now.
The weakness is that they're listed sequentially. The reader has to connect the dots themselves, which makes the technical support feel arbitrary, just a line on a chart.
And a technical floor only matters if powerful money is actually there defending it.
I see. So the suggestion then is to use that institutional data as the fundamental validation for the technical bounce. Reframe the whole argument to show that the Q3 accumulation from smart money is the actual force confirming the strength of that support level.
It creates a story. The story isn't just the stock hit support and bounced.
No.
The story is that Millennium Management, after doing their homework on the negative enterprise value and the Tanya launch, decided that 1380 was the definitive entry point, and their huge buying volume is what created that bounce.
It's the difference between just citing evidence and actually weaving a narrative. We need to explicitly link the timing of those Q3 institutional buys to the price action near the all-time lows. You make the institutional data the cause, and the technical floor the effect.
And use strong active language for it. Phrase the institutional buying like Millennium adding nearly 500% as the defining buying interest that specifically created that bounce and established the current floor.
That five-fold increase in their position isn't a coincidence.
No, it's an indictment of the prior valuation. It proves the downside is limited because the biggest asset managers are stepping in right at that consolidation zone. That gives conviction for watching the 1550 resistance breakout. You transform technical analysis from just chart reading into measuring the flow of informed capital.
And that integration, marrying the fundamental flow data with the technical price action, just makes the entire thesis feel so much more sophisticated and professionally researched.
Exactly.
This has been a really insightful critique. It's all aimed at maximizing the impact of this bottom is in TNXP breakdown. The initial submission was strong, no doubt, anchored by that negative enterprise value and the new commercial angle.
The key is transforming that strength into real conviction. And we've identified, I think, 3 major opportunities for the writer to implement.
First, dive deeper into the nuances of that negative enterprise value. Proactively model the historical cash burn against the projected Tamiya revenue. This directly tackles and mitigates those dilution fears that have kept the valuation so low.
Second, fortify the risk section. Create a dedicated counterargument segment and tie those counterarguments directly to the specific execution challenges. So analyzing payer hurdles for Tamiya and providing a framework for monitoring the clinical risks, like the placebo effect, in that MDD trial.
And finally, integrating the institutional buying data with the technical price action to create a much better narrative flow. Show the reader how the smart money confirmed the floor and established this range rather than just listing accumulation as a footnote.
These steps will turn what is a very persuasive investment case into one that feels definitive and actionable. We invite the listener to refine the piece based on this feedback and submit their updated work back in for a